Matters Radio Network.
How does your DAV membership benefit you? As a DAV member, in addition to DAV programs and services, members are entitled to a member benefits package, which gives you access to a variety of important programs, products, and services. Also included with your membership is a free subscription to DAV Magazine. For more information, visit davma.org. That's davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what kinds of things do people need to look at to know whether or not they can undertake a successful retirement?
Yeah, I mean, first steps first, we talk about your income sources in retirement versus your expenses. And usually the easiest thing today is to look at what are my income sources now, how will they change, and what are my expenses now, and how are they likely to change. On the expense side, oftentimes it's not that big of a change, but I think that's the first starting point before getting into more complicated things such as my investment portfolio, my health insurance situation, or Social Security strategies.
Mike, a lot of times people are concerned about whether they have enough to live all the way through retirement, and so they might delay their retirement significantly. But it's also worth pointing out that sometimes the biggest risk is not retiring early enough, and you might miss out on some retirement years that way.
Yeah, I mean, look, we all do get worried about longevity, and there are plenty of warnings out there in the media about how Social Security or these other things might not keep pace. But man, it sure is devastating to see the opposite one, where you work your whole career, work your tail off, save all this money, and it can impact your health. It can impact all sorts of things. And to not get to enjoy that full retirement because you choose to work longer than you might have needed to is so much more frustrating.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number again is 800-393-4001, or you can visit armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Well, get up, dust off those rally caps, and get ready for it, because this morning equities attempting to stage a back-to-back day of positive returns, which normally wouldn't be a big deal at all, but after the last week and a half, many days of which we had 6 days in a row of down markets, many of which started off with positive days in markets. We this morning have the Dow, S&P, and NASDAQ all strongly in positive territory, building on yesterday's gains. NASDAQ, by the way, leading the way up about 1% in early market trading. It's Mike Armstrong, Paul Lane, and Tucker Silva with you on a busy Tuesday of earnings, as we kick things into high gear here this week when it comes to tech earnings in particular, but earnings across the board. Just giving you a sense of what we're seeing. Pepsi, GE Aerospace, which is the leftover parts of GE.
Flagship.
They still get the GE ticker symbol there as GE Aerospace. Novartis, Danaher all reported earnings before the bell this morning. You also heard from Philip Morris. RTX, which is Raytheon, and who did they merge with?
Was that?
It's the owner of Otis Elevators. You're right,
Yeah.
but other defense company. So they are now just RTX company. UPS reported Nextera. So lots of earnings
United
coming
Technologies?
out.
United
Yes,
Technologies.
thank you. After the bell today, though, some big heavy hitters. You'll have Visa reporting earnings, as well as Tesla after the bell today. Then later on during the week, we have even bigger companies heating up. So Meta will be reporting after the bell tomorrow. Thursday, you've got Microsoft and Google reporting after the bell. Friday, do we have anything big on Friday? Yeah, we've got ExxonMobil and Chevron reporting before the bell on Friday. So as I mentioned, very, very busy week for earnings as we kick things into high gear here. And we've posed this question before, but I come back to it, which is, will earnings this season have the ability to outweigh the impact of higher interest rates for longer, which seems to be the new narrative that is taking form here as we head into first quarter earnings reports. Paul?
It's really going to be important, Mike, particularly the Magnificent Seven, those earnings reports that we see this week, in order to keep any type of momentum going with the equity markets, because as you mentioned, the sell-off that we've seen over the last 2 weeks, I would say, or so, has been largely driven by inflationary concerns. And what we've had prior to the inflationary concerns, I mean, it's always been an issue, but the most recent renewed concerns is equity valuations soaring over the last 6+ months, and even further back, probably 18 months or so. It's been on the backs of companies like NVIDIA, Microsoft, Google, and others in this group here, and it's because they have been driving the profitability growth that we've seen. NVIDIA has been an absolute rock star, tripling their sales last year, selling $47 billion worth of chips. They're anticipated to double that number this year. You don't have companies often tripling and then subsequently doubling their sales in back-to-back years. And that's where you've gotten a lot of the drive up in some of the market caps and the price to earnings on that tech sector in general. So there was a key stat that was pointed out here in one of these Bloomberg pieces that we were looking over for the stack, where the Magnificent Seven as a group it was anticipated that for this upcoming year, we'll see a 38% profit rise in those companies. If you strip out NVIDIA in terms of that profitable gain of a 38% rise year over year, you're down to 24%. So it's making up a significant amount of the anticipated profit growth. And you compare that to the rest of the companies in the S&P 500, 2.5% year-over-year earnings growth. So I can't reiterate enough that these are the companies that are fueling the market rally. So it'll be interesting to see what they come out with this week.
Can we talk about one of these things that doesn't quite look like the others for a moment here? Let's just run through the Magnificent Seven. We've got Amazon with a market capitalization of $1.85 trillion. We've got Apple, market cap still, even after this year's losses, nearly $2.6 trillion. NVIDIA, $2.03 trillion. Meta, $1.23 trillion. Microsoft, nearly $3 trillion. And Alphabet, nearly $2 trillion. Then we've got little old Tesla here.
Scrappy upstart.
Yeah, not exactly. They once had a market capitalization of over $1 trillion, nearly $1.2 trillion, or nearly $1.25 trillion. Currently sitting at about $400 billion. Smaller than Visa, smaller than ExxonMobil at this stage, smaller than many companies that were once pushed to the wayside in favor of Tesla. So Tesla has a lot to prove after the bell today. When they go and report their earnings, we'll be talking about them a little bit further during the show. But starting to be the
Is the committee going to kick them out of the Magnificent Seven?
There is none. So
should
I
we
guess,
go to the Sexy Six instead?
Yeah, I guess we might have to at some point if they continue this push, this black sheep push. But nonetheless, that is going to be what dominates things. As I mentioned, we've got the continued story of interest rates and where they will end up this year, just to give everyone a sense for expectations, at least. The next meeting coming up is May 1st. There is currently a 96% chance here that the Federal Reserve does nothing at that meeting to lower interest rates. When we take a look a little bit further out, we've got another meeting June 12th. They're currently pricing in, according to the Chicago Mercantile Exchange, 83% likelihood that the Fed stays at the current set of interest rates by then. By the July 31st meeting, still a 54% likelihood that rates are exactly where they are. And finally, by year end, most likely scenario for interest rates still by this December meeting is for rates to be between 4.75 and 5%. I personally, here's my viewpoint on this. If you buy that the Federal Reserve is going to keep interest rates where they are by the July 31st meeting, then you won't see any other action by year end. I don't see really. I think it's going to be very, very difficult for the Federal Reserve to justify moving rates in one direction or another after July 31st. You get too close to election season, and whether you are hiking rates at that point or lowering rates at that point, you look like you're putting the thumb on the scale of politics, and that is not anything that the Federal Reserve wants to be accused of.
It would take an extraordinary event for them to take those measures, and it's hard to foresee any sort of economic strife in that short period of time that would necessitate that type of cut there.
So as we head into earnings, not so much for Tesla, but for some of these other companies, NVIDIA most certainly is front and center for artificial intelligence, but Meta, Google as well, will be hearing about their earnings reports this week. And the questions are going to start piling up in terms of when do we start to see the impact of artificial intelligence? NVIDIA, fairly obvious. Everybody's buying their chips. Got it. But when you talk to Microsoft, when you talk to Google and their management teams, what exactly is going to be the plan for how they utilize artificial intelligence, and how is it going to add to the bottom line? Probably not the most important thing this quarter, but the longer we go on, the more bets that are being lined up on AI being this groundbreaking technology, the more investors are going to want to see, if not profit growth, then sales growth as a direct result of AI.
Sales growth and proof of concept, right? Because when you talk about NVIDIA, and you mentioned it, Mike, they are the beneficiaries of the surge in demand to explore this revolutionary technology. But the other side of the coin there is developing the research and development in order to make this a useful technology. You have to see the merits of its work, and eventually Wall Street will get impatient in terms of the updates that they're seeing. I guarantee you what we will hear is as many anecdotal notes from these companies as to how magnificent the technology is and the significant strides they're making. But those are all just BS kind of statements. You have to eventually back that up with numbers. The only real close proxy that we could possibly have is Microsoft has been really heavily tethered to AI because of their significant investment in OpenAI. So it's estimated that perhaps that AI in general, which is being utilized by many of Microsoft's Office, I believe Copilot is one of the ones that they are unveiling some of these AI features. It's estimated that in its cloud computing division, AI has bumped its revenue by about $3 billion. Again, these are very rough estimates. That sounds like a big number. It's only 1% of Microsoft's revenue over the course of the year.
Yeah.
So it has to start to become a bigger piece of the pie. I'm not necessarily, when you're talking about Microsoft's revenue, it's a big pie to chip into, but it has to start improving, has to start showing some inroads of implementation. I don't think you're going to see that for a while. It's how long are these companies willing to spend aggressively to develop the technology without getting imminent dividends from the work that they're doing.
Yeah, I guess if I'm looking at the artificial intelligence development, I have three major themes of questions. Probably the most important one is the one that you already asked, which is, okay, Microsoft or Google or Meta or any of these companies, whether they are big players out there or companies that might not even seem to have that much direct relation to AI, like a finance company, how are you going to utilize this to boost sales and or profit? That's
and productivity.
That's a
probably
big one.
Yeah.
Second big question I have about AI, if you are doubling down on this strategy, where are you going to get the energy infrastructure from? This is a growing question that we'll be talking about, I think, for years to come now, is this requires massive computing power, the likes of which our grids are not really set up for. You have a bunch of companies playing in this space that have made big commitments on carbon emissions and net neutral in terms of their impact on that stuff. So where are you going to get the energy from to do all this? And then the third one is just kind of a lingering one that is in the back of my mind and is kind of yet to be played out. But all of these artificial intelligence platforms, the large language models that exist today,
right,
were built on scraping the internet. Content that was used to create all these large language models. And there are going to be lawsuits that play out for years here on whether or not the fundamental bedrock, the foundation of how these artificial intelligence systems were created, whether or not that specific action was illegal.
Or, more importantly, too, is it accurate? Is it truthful?
Yeah, all of those things important. Because from what I understand, there's no real ability for ChatGPT to go back and say, oh, well, we lost this court case to New York Times, so we're going to have to reteach all of our systems to just get rid of all the New York Times data. That's not how it works. And so those are the three thematic questions that I have for AI and how it's going to develop over the next few years. And we're at the very early stages. I'm sure there'll be more questions that pop up as time goes on. But to me, most questions and most hopes and aspirations I have for these tools fall into one of those three buckets. Is it based on a whole bunch of illegal actions that were taken years ago? How are you going to utilize it to drive profit and sales at your business? And then third, how are you going to energize it? Quite literally, how are you going to power the needs of this industry, which right now are pretty significant? Let's take a quick break. I went on a bit too long, but when we come back, we're going to be talking Tesla. Big earnings report coming out this evening. As I mentioned, we'll cover that next on the Financial Exchange.
Miss any of the show? The Financial Exchange Show podcast is available on Apple, Spotify, and iHeartRadio. Hit the subscribe button and leave us a 5-star review. This is the Financial Exchange Radio Network.
If you're one of the millions of Americans at or nearing retirement age and you don't have a solid plan, it may be difficult for you to enjoy your retirement years. Hi, this is Chuck Zada from the Armstrong Advisory Group, and I've got some questions for you that may offer some guidance as to whether now is the right time for you to retire. Can you retire? Do you have enough money to live the way you'd like to? Should you retire, or have you exhausted your time in the workforce? Regardless of the answers to these and other questions, our new guide called Preparing for an Upcoming Retirement can provide some insight that may help you make make the right decision. Call 800-393-4001 to request your free copy of the guide and get a head start on building your retirement plan. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
Get up-to-the-minute market updates with Wall Street Watch, weekdays at 10:30, only here on the Financial Exchange Radio Network.
The Financial Exchange has built an incredible partnership with the Disabled American Veterans Department of Massachusetts. We can't wait to take part in this year's DAV 5K, set for Saturday, November 9th at Fort Independence on Castle Island, and registration's now open. You can help our great American heroes by walking, running, or simply making a donation. Your gifts will support services such as the Veteran Advancement Program, which offers permanent and affordable housing opportunities for veterans and their dependents. Learn more at dav5k.boston. The DAV 5K Boston is presented by Veterans Development Corporation.
So, I mentioned a bit of a wild ride that it has been for Tesla. So Tesla has lost more than half of its value from when it was over a $1 trillion stock. And that wild ride, like I mentioned, they hit an all-time high in November of 2021. I believe that was the $1.25 trillion market cap. They then lost nearly 2/3 of their value in 2022 before doubling once again in 2023. And then once again in 2024, sliding dramatically once more. So as I mentioned today, this is a company that is now smaller than Visa, smaller than ExxonMobil. They are, for obvious reasons, by the way, too. I mean, this is not a company that is unprofitable. It is a company that has dramatically slowed down in terms of their ability to prove themselves as this high-flying growth company. And so many investors are, I think, appropriately asking, okay, what happens next, Tesla? What is going to be the next big growth engine? And are you going to be able to move that forward?
It's hard to get too overly involved in earnings reports on a quarterly basis. There's been some criticism by the economic community in general of getting too bent out of shape behind one earnings report or another, because oftentimes they're just a blip on the radar. You should be focused on the longer term of the country. However, I will say, Mike, this earnings report coming up for Tesla, it's a very critical one. It certainly is incredibly significant, because what you've had is really slow sales growth in terms of Tesla's numbers. I've mentioned on the show before, the projection on their sales has retreated significantly from where they were last year. China looms as a huge threat. I mean, what China is doing in terms of, I'm not sure what the governmental practices are going on there right now, but no one is buying Apple iPhones. No one is buying electric vehicles from Tesla. And what you're seeing is a huge amount of nationalism push. China is trying to shift the sentiment on their country in general to being a manufacturing powerhouse, particularly targeting some of these areas. We've talked about the inroads that they've made on the chip market, whether it's legacy chips, making sure that these people in China are buying Chinese products. And BYD has been the largest beneficiary of that, once claiming the title of the largest EV maker in the world. They're subsidizing the prices to drive them down significantly lower than the competitors. The fact that Tesla has had to cut prices a series of different times for what once had really the flagship brand in the EV space, it's concerning. The demand has really eroded in China. And then you've also seen in the US $2,000 cuts on each of the Model X, Y, and S. All of these things cutting your global workforce by 10%. A lot of these things add up to what probably will be a weak quarter. We'll see what comes out after the close here. The last piece that I'll mention there, profit margins too. Typically, car manufacturers operate really low profit margins. Sure. If you look at Ford or GM, you're talking 5, 10, 15% if you're lucky. The thing that was so amazing about Tesla is because of this brand, they were able to charge more for their vehicles, operate growth profit margin around 30% at one period of time and hit that peak. Now it's down to 19%. More scrutiny when you cut your prices, that margin's going to lower. So just a lot of concerns here, Mike.
Yeah, I think if there's, again, three questions that I think Elon Musk is going to face heavily at the next earnings call. One, what are your plans for the cheap vehicle, the Model 2? Because Reuters reported that they were dropping their plans for the Model 2. Elon Musk tweeted that Reuters is lying. So what's the story? Are you actually dropping it, or are you focusing on it? Robo-taxis, you've hinted, Elon, that you're planning on rolling out a fleet of driverless robo-taxis that they are going to unveil in August. Is there anything truthful to this, or is it just more fluff? And then third would be, you yourself, Elon, have warned that Chinese automakers could demolish, quote, their rivals, which you are one of them. And so is there any plan B? How do you maintain your sales in China or grow your sales in China amidst this competition? And we'll be talking more about that Chinese competition later in the show. Quick break. We've got Wall Street Watch coming up.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
If you're thinking seriously about retirement, now's the time to build a sound plan that will help you enjoy your later years. This is Mike Armstrong from the Armstrong Advisory Group, and if you're one of the millions of Americans at or nearing retirement age, it's important to understand how to develop this plan, and our new monthly guide may help. In it, we discuss strategies to prepare for an upcoming retirement. We'll walk you through the process of putting together a retirement income strategy, exploring your healthcare options, and managing potential financial risks. There's also the crucial issue of maximizing using your Social Security benefits. Call our office today at 800-393-4001 and get your copy of this new free guide, Preparing for an Upcoming Retirement. That number again is 800-393-4001, or you can request it from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi Code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, how can you ensure that your kids' inheritance can be protected from future divorces?
Well, estate planning, as you know, does things like avoid probate, protect assets from nursing homes, and reduce taxes. But you know what? The family behind the estate plan can be more important. And so the trusts live on after you die, and you can have language in there that divides the assets to the children, but doesn't just pay it out, right? It holds it in trust for them and allows them to be trustee, but just not take it. In order to get it, they have an independent trustee that can say yes or no. And that way, by not owning the asset, if they get divorced down the line after you're dead and the other side says, hey, I want half of what's in that trust, you're going to say, that's great, but you have to ask the independent trustee. So it's now not going to be available to you. And more than just the ability to say no, it's the fact that you don't own it. So if you don't own it, it's not a marital asset to begin with, so it should not be even subject to the divorce. So learning how your trust works after you die can oftentimes be more important than when you're living, and it does more for you after you die than when you're living sometimes.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
A Well, the rally is extending on Wall Street today as Wall Street reacts to a flurry of first quarter earnings streaming in this morning, in addition to new economic data, including on the manufacturing front and new home sales. Right now, the Dow is up by 202 points, or just over 0.5%. S&P 500 up by 55 points, over 1% higher. And the tech-heavy NASDAQ surging by over 1.5%, or 236 points. Russell 2000 also up by over 1.5% as well. 10-year Treasury yield down by 4 basis points at 4.58%. And crude oil up about 0.25%, trading just above $82 a barrel. Pepsi posted better than expected earnings and revenue for the first quarter this morning, as its volume and sales growth were better in most international markets than its North America segments. Net sales climbed 2.3% to $18.25 billion for the quarter. However, Pepsi did see a volume decline in response to higher prices for its Gatorade, Fritos, and other products in its portfolio. Pepsi shares down by about 3.5%. Meanwhile, JetBlue shares plunging 15% after the airline lowered its 2024 revenue forecast as the carrier attempts to return to profitability. JetBlue also said its second quarter revenue would likely fall as much as 10.5% on the year, more than double the drop that analysts had anticipated. Elsewhere, Novartis shares climbing 3% after the pharmaceutical company hiked its full-year guidance, while also posting stronger than expected first quarter results. According to CNBC, Walmart's majority-owned fintech startup One has begun offering buy now, pay later loans for big-ticket items at some of the retailer's more than 4,600 U.S. stores. Walmart shares down by about 1.5%. And as mentioned earlier, after today's closing bell, we'll see highly anticipated first quarter earnings from Tesla. So far today, Tesla is up by about 2%. I'm Tucker Silva, and that's Wall Street Watch.
Paul, you familiar with the term, the government program, Cash for Clunkers?
Cars for Kids?
Different. Cars for Kids is a charity.
We dove into that on the show once. It's didn't really understand what the charity was behind, but now I get it. Anyway.
So, Cars for Kids is a charity. Good jingle. Cash for Clunkers, very different story. This was a 2009, I believe, basically stimulus program in the United States. The idea was if you trade in your vehicle for a more fuel-efficient one, then you would get a government subsidy. I think it was up to $4,500 for trading in your car for a more fuel-efficient vehicle. The effort was dual-focused. One was, get more fuel-efficient vehicles on the road, but more realistically, the U.S. automakers were just coming out of bankruptcy and boost some sales. Mm-hmm. It's always strange to me how history just seems to mirror itself, because China seems to be taking a page out of the Obama playbook here with their newest government program. They want everyone to be trading in their old cars and fridges to help save its economy. So, again, why is China doing this? Likely the exact same reason we did in 2009. They've probably got a whole bunch of products sitting in warehouses across the globe across the country that they could try and flood foreign markets with, but then we'll see even more pushback against them for what they've been doing. And they also probably overestimated domestic demand after the real estate crisis that's occurred. And so what are they going to do? They're going to basically subsidize, it looks like, the Chinese consumer to trade in old dryers, old cars, in favor of new, more fuel-efficient, more energy-efficient versions of the same things. So we don't know exactly what the subsidies are going to look like, but this is likely to be a multi-billion-dollar effort on the part of the Chinese government. This ties into exactly what I was saying in the first segment there, Mike, with this idea that they are trying to position themselves as this manufacturing industrial country, and to do so, they're willing to prop up numbers however they can, whether it's through trade-ins or through government subsidy, both of which are basically
tethered to government subsidy. That's what it's going to be, and that's what they're going to tell, and that's going to be the story they're going to tell, because we all know the real estate story is dead, so they have to come up with a new way to say that they're innovating and developing their economy, because consumerism is just not working there. It has failed miserably, so this is their pivot point, and you can believe that they will do everything to stoke the numbers to make it seem like they have gone through this amazing transition, and that's concerning for the people who play in the space, like a Tesla we talked about before, like others in China, and it ties into this GM piece as well.
Yeah, so I guess my key takeaway from this is, and again, we don't have details on what this program is going to look like. I doubt they're going to call it cash for clunkers, but that's basically what it is, but more than just cars in this case. Were I a betting man, I'd be willing to bet that China would not be willing to offer subsidies for their citizens to trade in their old car for an electric General Motors or Tesla. I don't know. Could be wrong. But my guess is that they are going to be focusing on cars from companies like BYD and other Chinese domestic manufacturers that they are trying to prop up the sales for. And so, as you mentioned, we've got this story from General Motors. And General Motors, by the way, as of 2017, General Motors had 14% market share in China. 14% of vehicles sold in China were General Motors vehicles. As of 2023, according to Bloomberg, that was down to 8.4%. They actually reported pretty good earnings, raised their profit outlook for 2024. General Motors stock itself up about 5% in early trading today. But I would personally be willing to bet that General Motors has no competitive edge in China going forward. They will be able to sell their big, heavy trucks in the United States and North America, but I am not sure what the path is for General Motors in China.
In China, certainly, I would agree with you. It's a pretty bleak picture because of all the things that we talked about. I would give them a quick golf clap here because these numbers that they came out with for 2024 and their profit outlook are really strong, and I give them some credit for really going back to basics, Mike, and just focusing on what are our core competencies, and let's really put in time and resources to strengthen those as best as possible, because they had tried to develop a driverless car through Cruise, and that has been a miserable failure. They've really cut back on that. In San Francisco, there was some really scary instances of the driverless cars just failing entirely with pedestrians. That saved them $100 million on their bottom line, peeling back the investment there. You really don't hear about their EVs much at all, Mike, anymore. They don't even break out EV performance on their quarterly earnings, but they've also sort of sidestepped that. I mean, they'll tell you, hey, it's coming along, we'll get there. But what they did, back to basics, are the pickup trucks and share buybacks. That's really been their focus, is returning cash to shareholders, and they came out with a 24% rise in Q1 profit as a result of it.
Yeah, big increase in quarterly profit. They raised their guidance for pre-tax profit before non-recurring items by $500 million. That's bringing it to a range of $12.5 to $14.5 billion. So, yeah, the only real negative that I can point to here is China, right?
Yes.
They lost $106 million for the quarter in the world's largest car market by sales. I think this is actually the first quarter in a long time that U.S. sales outpaced China sales by volume, which is, again, just crazy to think about. But, yeah, that's been the case, that they sell more vehicles over there. And, this company, as well as many others, had a lot of lip service to electric vehicles over the last year, and the question that I don't really know the answer to at this stage is how much actual investment did they put into these EVs that are clearly not facing the same demand equation that they thought they would, versus how much of it was just lip service. Because if it was mostly lip service, you're actually in a pretty good place heading into 2024 here if you can pivot and focus more on hybrids like Toyota is doing and like others are doing. But I'm just not sure how much of it was just that, the lip service, as opposed to real fundamental investments that were made. Let's take a quick break. When we come back, a couple more points on China, specifically when it comes to Apple and what they're going to need to revive their growth story. Stock's been down substantially this year. A lot of questions being raised about where they go from here and what is that next leg up for Apple. We'll cover that next on the Financial Exchange.
There's only one show that follows Wall Street's continued volatility. Keep it here all morning long on the Financial Exchange Radio Network.
Beneficiary planning and asset protection go hand in hand, and Cushing & Dolan, the experts in elder law and taxation, can help make your planning process smooth and easy. Simply saying you're leaving everything to your kids isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can cost you dearly in the long run. That number again is 866-848-5699, or you can request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Millions of Americans are preparing for retirement, and if you're one of them, making sure you have a solid plan is the key to enjoying your later years. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and I'd like to ask you two simple questions. Can you retire, and should you retire? Our new guide is called Preparing for an Upcoming Retirement, and in it, we'll discuss strategies that can help you answer these questions and others so that you can make the right decision for you and your family. There are many different elements to a sound retirement plan, including knowing how much income you'll need to live comfortably, when to take Social Security benefits, and understanding what financial risks might be worth taking. Get your free copy of our new guide, Preparing for an Upcoming Retirement, by calling 800-393-4001, 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. Visit the U.S. Virgin Islands and enjoy your next incredible vacation. Explore St. Croix, St. Thomas, or St. John, and enjoy pristine beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
America's sweetheart Apple is currently trading at $166.37 per share. They're off a little bit over 10% this year and down from a 12-month high back in December of last year of $198 per share. They've faced challenges from a few different areas. Certainly one of them would be regulatory scrutiny, mainly from Europe on a number of their practices, and that seems to be continuing. But the bigger problem for Apple, quite honestly, because they can afford just about any fine that the EU sends at them, is just lack of demand for their products right now. This has been a story that I think has played out many times with Apple, right? I mean, how many times have analysts said, oh, look at that, quarterly, year-over-year sales growth of their iPhone has taken a hit. And really every time over the last 2 decades, they've responded very strong to those criticisms. They have come up with new products. They have, created markets that didn't previously exist. The market for people who was buying $600 watches before Apple came around with theirs was tiny, and they created a massive market for people willing to spend $500-$600 on watches. So
on a digital watch, probably, yeah.
In general, right? Like, how many people did you know before? When did the Apple Watch come out? 2015, maybe. Let's call it 2015 since I'm making stuff up. How many people did you know in 2014 who were buying $500 plus watches? To me, it was very, very few, and all of a sudden you've got a big market for watches that, granted, the smartwatch does a heck of a lot more than your traditional Fossil or whatever might cost you $500, but it's a watch. Likewise, people spending a couple $100 on headphones was, again, fairly rare, and these days they've made a fashion symbol out of the I was going to say AirBuds. That is a different thing. That's
great movie.
Great movie featuring a golden retriever.
True story.
Is it? But nonetheless, Apple's China iPhone sales have taken a 19% dive in the worst quarter since 2020. And this is another one where China is not out there calling for cash for clunkers when it comes to your smartphone. This is not part of the last program that I just talked about where they're asking people to trade in their cars and old dryers for new, more efficient models. But clearly, Apple is facing some sort of issue in China when it comes to demand, and I'm not sure if it is a nationalism problem. I'm not sure if it is a cost problem or some combination of all of those. But Apple is suddenly in a position where domestically demand is fine. You don't have a bunch of people switching off the iPhone to go to the Google phone, most certainly. But people aren't upgrading their phones as frequently as they used to. The phone carriers aren't subsidizing the cost of those phones as much as they used to. And so globally, they're facing this bit of a downturn when it comes to sales. And I think it's been a while since they've come out with that latest innovative product that's going to define a market like they have many times before.
To me, to answer your question, it's more the nationalism piece. If you look at Huawei's recent growth, it's hard not to kind of put 2 and 2 together and see if perhaps there's just a more nationalistic focus on Huawei, particularly because I believe they were able to incorporate a chip in their phone, Huawei's phone, that the U.S. was trying to sanction to prevent. So perhaps making it more attractive for people to purchase those phones. I'd like to pose another question, as to Apple and its future. There's a piece here in Bloomberg that sort of pontificates if, Apple should come out with a lower-end iPhone. And this is not a new idea. They've tried to do this before. And I'd push
What's the cheapest iPhone? Like $750?
No, there's
in the U.S. anyway.
This SE, which is kind of like outdated, I read here is like $430 right now.
Wow.
But that's almost a dying breed. It seems like that there's just really not mass adoption of the iPhone SE. I'll have Tucker confirm if I'm on the right track with that being the cheapest one out there.
Yeah, it's the SE.
But it just hasn't really worked. And to me, the way Apple is positioned from a brand perspective, I just am not in agreement with this idea of coming in with a lower end phone, particularly if you're going to be going head to head with a Chinese smartphone market that may be heavily subsidized by their country. I just don't think that strategically makes the most sense. I think you're much better off trying to develop a premium product. And the argument is, geez, there hasn't been a lot of innovation since the iWatch, but that would be more of a focus for me rather than sort of putting yourselves in the mud, the lower end side of things on the phone side.
$429, by the way.
Okay. Wow, that is cheap. So this is a piece in Bloomberg by Mark Gurman, by the way. And yeah, I read this through, and I was really trying to think about it. Like, here in the United States, I am 100% with you. Apple, you have the brand recognition of being the premium phone, and people are willing to pay for it. If they go and cheapen their brand by rolling out a bunch of lower end iPhones, I don't see that as a successful strategy. Mm-hmm. I think the question that Mark and others are asking Apple is, okay, you're pivoting away from China. You're focusing on India. You're focusing on Africa. You're focusing on other areas of the world that you think will be the next potential development, the next big partner. Can you do that? Can you have the same strategy there, or do you need to go lower end in terms of the phones? And that is a really, really tight rope to walk, right? Like, hey, we're going to go into India with a completely different type of brand than we have in the United States. But what study after study have shown, so I am, the embarrassment of my whole family because I am an Android user.
Green bubble.
And, they intentionally leave me off text messages so that I don't ruin all their pictures and videos. And it's, I'm the black sheep of the family.
Wasn't that supposed to be being resolved? I guess not yet. But
I think it is supposed to get resolved, yes. But what study after study have shown is that the platforms themselves, Android versus Apple versus whatever Huawei operates on, there are key differences. But the biggest thing is that nobody wants to switch from one to the other.
Right.
That once you are integrated and learned on a certain platform, you have no interest in switching over. And so if Apple really firmly believes that services are going to be a big area of their growth in the future, maybe it's some AI tool, maybe it is Apple TV and Apple Music and Apple Storage. If that is their firm belief that, hey, these are going to be a major growth engine for our profit margins, is not just the iPhone sales, but the universe of services that go along with it, then they may have to consider that discounted product in these markets. Because I don't know how you sell a $1,000 iPhone in India. It's going to be extremely challenging to do so.
I agree with you on all the points in the development in those other countries. To me, I feel as if they would be better off making innovations to the existing iPhone that made it more enticing for U.S. and other wealthy countries to continue to buy them. There really hasn't been a lot since 2017. The iPhones have stayed relatively the same.
Quick break, but we've got a lot more to cover in the second hour of the Financial Exchange, including the extremely strong recent dollar rally. We'll cover that next, coming up.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what are some of the things that can derail a retirement that otherwise would be going fine?
I mean, there's all sorts of items. Certainly, a pension going bust or Social Security getting reduced, people worry about. Certainly, we all worry about market volatility and the risks there, or inflation. But one of the ones that I think people almost intentionally avoid is the risk of increased healthcare costs. I think we're familiar with Medicare costs and things along those lines. But the portion of Americans who will face some sort of heavy end-of-life care and the costs associated with it, it's a big chunk of Americans, and gosh, it's such a taboo issue that we hate talking about and being transparent about. And so you really have to tackle that one and be straightforward with the potential risk.
It seems to me that just doing some stress testing with some actual numbers can make a big difference in determining whether or not that can cause a problem for you.
Yeah, most certainly. But the costs of things like nursing homes or assisted living facilities are so frightening to people and almost unfathomable in terms of total cost that we just choose to stick our head in the sand sometimes. And that's not necessarily the wrong approach to things like market volatility. But when it comes to planning out your future financial success, putting your head in the sand is a losing strategy.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two different ways that you can request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. That phone number again is 800-393-4001. 393-4001, or you can visit ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it, and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
Do you use the expensive blue or yellow pills to charge your sex life? Are you thinking about it? What if we can promise you the same results for less than $3 a pill? If you're paying $20 a pill for the other pills, you're getting taken to the cleaners. Our pills deliver the exact same results for less than $3. You'll save more than $16 a pill for the same results. And right now, radio callers will get 44 blue or yellow pills for $120 with free discreet shipping. You can save more than $700 off pharmacy prices. Charge your sex life now and save a ton of money. Call now and get your 44 pills and save over $700 and qualify for free shipping. Stop overpaying and call right now.
Paid for by Steel Man Pills. 800-475-8547. 800-475-8547. 800-475-8547. That's 800-475-8547.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan has written a new guide that may help you avoid unnecessary mistakes that can cost you dearly in the long run and ensure that your assets are protected for generations to come. An example? The federal estate tax exemption has increased by nearly $1 million from 2023. That could lead to a larger inheritance for your family members. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Your Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Paul Lane. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Paul Lane.
Welcome back. If you're just joining us, markets are attempting to stage a second-day rally here. We've got the NASDAQ up 197 points, or 1.25%. The S&P 500 up nearly 50 points, or a full percentage point. And the Dow up 213 points, about 0.5%. The yield on the 10-year Treasury slightly down to 4.58%. Price of a barrel of oil is slightly up by 0.5%, sitting at about $82.29. And gold slightly down, $2,330 per ounce. It's Mike Armstrong, Paul Lane, and Tucker Silva with you on a Tuesday with a busy earnings calendar on the agenda here. And that continues to be the story that I think will be dominating markets this week and next, unless we get something else going on in the Middle East between now and then. But the story that continues to play out is earnings coming out. Bit of a mix out there. We talked about General Motors having good earnings. Pepsi disappointing a little bit in spite of robust sales, but currency issues that they're facing a little bit, as many U.S. businesses will face when they're translating their foreign sales back into dollars. And then some big heavy hitters coming out later this week, with Tesla reporting after the bell today, and I can't keep it straight in terms of who we have. Visa and Tesla after the bell today, Meta after the bell tomorrow, and then Thursday we will have Microsoft and Google reporting after the bell on Thursday. So big heavy hitters, a few $1 trillion worth of market capitalization reporting earnings this week. And that remains the story. Is will those earnings be strong enough, robust enough to counter the concerns that investors have about rising interest rates? And that's where we start the show today, is investors now pricing in a growing chance of another Federal Reserve interest rate rise. I mentioned that My personal view is unless you get movement on interest rates between now and August, you probably don't get any moves until after the election. And right now, according to the Wall Street Journal, options markets are suggesting that a roughly 1 in 5 chance exists of a U.S. rate increase within the next 12 months. That's up sharply from the start of the year and feeds into really everything, right? We talk about how a lot of people, we were talking yesterday about how most people really don't know Jerome Powell or what the Federal Reserve does or pay nearly as much attention to it as we do on the show here. But the reality is that interest rate moves and expectations about where interest rates are going to land impact a lot of everyday life. When you buy a home, when you pay interest on your credit card, on your home equity line of credit that you might have, maybe you're buying a car, leasing a car. All of these things come down to prevailing interest rates. And when it comes to the stock market, it has everything to do with how you value assets. You're looking at a risk-free rate of return. That's what generally people refer to as the yield on U.S. Treasury bonds for the 10-year at, like I mentioned, nearly 6% at this stage, 4.6%. And so compared to where that was a few years ago, when you are valuing the future profits of, let's say, NVIDIA and how much they're going to grow over the few years, you have to compare that to, okay, well, what could I be getting off of regular old risk-free treasury bond, and the higher that is, for longer it remains, the bigger those questions add up.
Yeah, if you look at the CME futures, which we did in the first hour of the show, the idea of a rate hike really doesn't even come up in terms of a probability for any of the meetings. Now, earlier this week, I had looked at it, and they were tabbing a couple % chance of a hike in the month of June. That's now completely off the table. But certainly there's an argument to be made that if we continue to see some of the inflation reports that we've seen over the first quarter of the year continue into the second quarter for the month of April when that data comes out and subsequent months, it will put a lot more pressure on the interest rate market. You know, this idea that is theorized in the Wall Street Journal piece that perhaps the 10-year could get back up to 5%, it's a possibility, but typically it would have to come, you would think, with a rate hike or at least renewed concern about inflation, even further than we've already had over the last couple of weeks.
That said, we're not far. Right? Yeah. I mean, we're at 4.6. That is not a massive move back up to 5%. So I won't write that off. We've talked a lot last week about this market right now compared to 2022. Mm-hmm. And there have been plenty of pieces written about similarities there. And if your memory isn't perfect, the S&P ended the year down 18%. The aggregate bond index, or the aggregate bond that you look at for measuring the total U.S. bond market, ended down 15%. They were off at their worst, more like 25% for the S&P 500. And a lot of things were happening then, but the big one that sticks in people's minds was that inflation was out of control, and the Federal Reserve was responding to it by ramping up interest rates. And does not seem like we're going to have that ramp up of interest rates in the same way this year, but, market interest rates have dramatically moved, and expectations about how much rates will get cut have dramatically moved this year. The yield on the 10-year Treasury started this year right around 3.85%, and we're now at 4.6%.
Right.
The other big difference in 22, though, in addition to the fact that you started the year at 0% on Fed funds and went all the way to 4.5%. That was a massive move, and I can't imagine the Fed going from 5.5% to 10% now. The other big piece in 2022 that drove markets, though, was slowing growth. Right. Many people out there were calling 2022 a technical recession, and whether it was a recession or whether it was not a recession, I don't really care. The economy sucked in 2022. People don't like it when I use that word, but I think it was appropriate in 2022. You had wages that weren't anywhere close to keeping up with inflation. You had no home sales, and you had companies reporting earnings that year over year were showing, in a lot of cases, slowing growth and profit drop in many, many instances. So in 2022, you had this combination of really high inflation, moving interest rates to the upside, and an economy that was in rough shape. It wasn't the rough shape of 2008. It was a different type of rough shape, but it was a slowing economy, GDP contracting. This year, we are once again facing inflation that is higher than anticipated. Not like 2022 when it was 9% year over year, but higher than anticipated. The reason that we have that inflation that is higher than anticipated is not because China, it's not because ships aren't leaving ports, it isn't because the Panama Canal. It is almost entirely because the U.S. economy is extremely strong right now. The unemployment rate is very low, and consumers continue to respond to survey after survey that while they're concerned about the economy, they are willing to spend money right now on discretionary items. The new Taylor Swift index that we're using right now, a few years ago to measure consumer demand and whether or not we were in a recession, or was that last year? Yeah, last year we were using the Taylor Swift index. How much are tickets going for Taylor Swift concert at Gillette Stadium? This year, I like the number of how many Americans are planning to travel overseas in the next 12 months. And as of the last survey from the Conference Board, it was half of Americans with passports were planning on traveling overseas. 21% higher than we've ever seen in the history of this question being asked. And if there's a better measurement of willingness to spend on discretionary items, what's more discretionary than traveling overseas for vacation?
It's up there. It's up there.
Right? Nobody needs this, right? It's not like replacing a car, which you might need to do because yours goes down. It's not like buying a home, which you might need because your family's growing. There are plenty of places that you can travel within the United States that don't involve going overseas. That is a pure discretionary spending item, and the Conference Board had it at the highest it's ever measured. So I do find that intriguing, and it speaks to, again, a key difference between right now and 2022. Not that I don't have criticisms about this economy. A lot of it is, on the back of massive government spending that has occurred over the last few years. All that's true. But the reason we have inflation right now is not because of supply chains. It's because of a strong U.S. economy. And until that drops off a ledge, I'm not sure that we should have the same concerns that we did in 2022.
Yeah, I believe it's Thursday that we'll get the GDP numbers, but it's anticipated to come in that the economic growth that we'll see from Q1 will be in between 2.5% to 3.5%, somewhere within that range. And that, to be clear, while that may seem like a small percentage to a listener out there, typically this economy that's very matured and developed grows at about 2%. So to be growing at 3% is quite strong.
Let's take a quick break. When we come back, we're going to have a little bit of trivia for you. That's next on the Financial Exchange.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
If you're one of the millions of Americans at or nearing retirement age and you don't have a solid plan, it may be difficult for you to enjoy your retirement years. Hi, this is Chuck Zada from the Armstrong Advisory Group, and I've got some questions for you that may offer some guidance as to whether now is the right time for you to retire. Can you retire? Do you have enough money to live the way you'd like to? Should you retire, or have you exhausted your time in the workforce? Regardless of the answers to these and other questions, our new guide called Preparing for an Upcoming Retirement can provide some insight that may help you make make the right decision. Call 800-393-4001 to request your free copy of the guide and get a head start on building your retirement plan. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, why can't you just add your kids to your accounts or to your house deed?
Well, you can. It's just not a good idea. So people who do that understand with an account, right? You can put a joint name on the account. Now, that doesn't actually complete the gift because you actually have to take the money out and then the gift is complete. But when you set it up, yeah, the asset would avoid probate. But if something happens to the child, it's going to be, available. Half the asset would be subject to the children's creditor. So you don't want that. And secondly, if you only put one kid on the deed, you've likely disinherited the other kids. So it's not really good planning overall. Whereas if you put the house in the kid's name, now you've actually made a completed gift of half the house and would need to file a gift tax return. Number one. Number two, of course, it's exposed to the child's creditors and, yes, divorces. You could find yourself at some point owning half your house with an ex-in-law. Not sure that's a good way to plan. So please, put together trusts. Don't just throw names on deeds or on bank accounts because, as I always like to say, nothing good comes from giving assets away while you're living.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
Trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night because half off is just more fun. Now, that's eating good in the neighborhood, void where prohibited, dine in only. Well, on this day back in 2005, the first video was uploaded to YouTube. The first video was posted by YouTube co-founder Jawed Karim and is titled Me at the Zoo. The video currently has over 330 million views. YouTube didn't last very long as a standalone company. Shortly after launch, the company was bought by Google for $1.6 billion. Trivia question today. What year did Google purchase YouTube? Once again, what year did Google purchase YouTube? Be the fifth person today to text us at 617-362-1385 with the correct answer. You can win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text, and we'll give away that Applebee's gift card on Friday's show. 617-362-1385. And the fifth correct response will be our winner. See complete contest rules at financialexchangeshow.com.
The FTC has had a busy few years, and they remain so. They are filing suit to block the $8.5 billion deal that would unite Coach and Michael Kors. The parent companies here, Tapestry, which owns Coach, and Capri, which owns Michael Kors. The combination would put multiple brands together, including Kate Spade, Stuart Weitzman, Jimmy Choo, and Versace, all under one roof. Some 33,000 combined employees there. European regulators and Japanese regulators signed off on the deal earlier this month, but U.S. FTC filing suit here. And what I'll say about the antitrust regulation out there is that I'm generally in favor of more competition, and I do like that the FTC has been more active. That having been said, I just have... I guess, you know what? I do not have the context to understand whether combining Michael Kors with Versace is going to lead to real competition problems in the global market for luxury goods.
I typically would find myself in the camp of just let market forces dictate and play out as necessary. So just not having so much government intervention with these types of lawsuits. However, since Live Nation and really the scrutiny there with, concert ticket prices and the way that they initially put some conditions on that merger and how it's kind of spiraled out of control, I now at least find myself pausing to think for a moment as to what the ramifications should or could be from these types of mergers. And I fall in the same camp. To me, I'm not the best person to speculate as to what this would mean, because I don't think I've ever purchased a luxury bag, even for my wife, if I'm remembering correctly. Certainly some jewelry out there. But the thing that did blow me away on a separate note, Mike, is their competitor. The reason that they're considering this merger is because LVMH is a absolute conglomerate behemoth in Europe. And I had a client recently who his daughter was trying to get in investing, and Sephora is a brand that she really liked. And he was curious as to how she could potentially invest in that just to get a sampling of the investing world. And I found it's owned by LVMH, along with, though, all the other brand names that we would all recognize. It's amazing. They have 90 subsidiaries of the biggest names out there, from Tiffany and several others. And so this is the reason why the strategy behind the merger, because they're up against an absolute titan. But to me, it's my guess as to, whether or not there's merit behind this lawsuit. I kind of get Kroger's and Albertsons. That merger is another one they've sued against. You want to have competition in the grocery space, but
especially in a market where you do in-person shopping. But with all this stuff, like, I don't know what portion of the sales are online, but it's probably a large chunk of them. And having this combined, I don't know. They're not selling the same products. I have a tough time envisioning how it's that problematic. The other piece that I just found interesting, which you do not frequently see in FTC cases, is them bringing up the potential impact on employees. Usually it's a question of how it's going to harm consumers. That's where the focus is. And if the FTC is trying to change the narrative on monopoly power to the impact on employees, I don't know where that goes. I don't know if there's any legal standing for it, but I just do find it interesting in terms of a meaningful shift. Tucker, you ever used Buy Now, Pay Later?
Nope.
Paul?
No.
All right. Well, it has been growing in popularity substantially, as we all know. Klarna, many other companies that offer this type of service, even Apple and Google offer a form of Buy Now, Pay Later. And what you should need to know about it for this piece is that most of those networks do not report those loans to major credit bureaus. So if you've ever seen Affirm is a big one that's out there, maybe you're shopping on Amazon and it says, make 10 payments of $19.99. You can sign up for one of those loans. They do not run a formal credit check on you when you're signing up for one of those loans. They put together data on you based on other factors that they have. But I think for concern of the credit bureaus as well as some lenders out there, they're saying, hey, when somebody applies for a mortgage, for example, and we run their credit, they could have thousands of dollars worth of Buy Now, Pay Later debt out there, and we would have no idea. So those Pay Later lenders are pushing back pretty strongly against having to report to these agencies. And my initial reaction was suspicion. Like, come on, get on board. But after reading through this, I actually understand some of the concerns. So it comes down to a pretty kind of technical issue. So let's say you have a credit card and you're buying a bunch of stuff on Amazon. That credit information is being reported to the credit bureaus, but it's being reported as one loan.
Okay.
So like I've used this credit, I've used this debt to finance dozens of purchases. If you're using Buy Now, Pay Later, what you're doing is you're signing up for a loan for every product you buy. So maybe I have borrowed less than Paul, who used his credit card, but I've done so with 8 different loans from Affirm, And we're basically doing the exact same thing. We're buying the exact same products. I'm spending less than Paul is. But when I get reported to the credit bureaus, because I'm utilizing such a number of loans, a high number of loans, my credit score is going to be dinged more than Paul's, even though Paul's spending is higher.
Huh.
So that's what I'm talking about when it comes down to these technical issues here. And then, maybe we just say like, yeah, that's fine. That is what it is. But that is why the Affirms and the Klarnas of the world don't want to report into the credit bureaus. It's not because they don't want the banks to know how much people are borrowing.
Well,
I'm sure it's that too. But largely, they're saying, hey, our customers are going to be more adversely impacted compared to somebody that's doing the exact same type of purchases on a credit card. And that does probably need to be justified and rectified in some way, because otherwise, fundamentally, it's the same type of borrowing for the same types of products. One shouldn't be penalized.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what kinds of things do people need to look at to know whether or not they can undertake a successful retirement?
Yeah, I mean, first steps first, we talk about your income sources in retirement versus your expenses. And usually the easiest thing today is to look at what are my income sources now, how will they change, and what are my expenses now, and how are they likely to change. On the expense side, oftentimes it's not that big of a change, but I think that's the first starting point before getting into more complicated things such as my investment portfolio, my health insurance situation, situation or Social Security strategies.
Mike, a lot of times people are concerned about whether they have enough to live all the way through retirement, and so they might delay their retirement significantly. But it's also worth pointing out that sometimes the biggest risk is not retiring early enough, and you might miss out on some retirement years that way.
Yeah, I mean, look, we all do get worried about longevity, and there are plenty of warnings out there in the media about how Social Security or these other things might not keep pace. But man, it sure is devastating to see the opposite one, where you work your whole career, work your tail off, save all this money, and it can impact your health. It can impact all sorts of things. And to not get to enjoy that full retirement because you choose to work longer than you might have needed to is so much more frustrating.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number again is 800-393-4001, or you can visit armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is now available on your Alexa smart speaker. Ask to play the Financial Exchange and catch up on anything you might have missed. This is the Financial Exchange Radio Network.
Trivia question today was, what year did Google purchase YouTube? That'll be 2006. On October 6, 2006, Google announced it was purchasing YouTube for $1.6 billion. YouTube's sale to Google came just 18 months after the video streaming pioneer was launched. Today, YouTube is the second largest search engine in the world, behind only Google. Deborah from Hathorne, Mass, taking home the Financial Exchange Show t-shirt, and Deborah's also registered to win a $100 gift card to Applebee's, which we'll give away on Friday's show. And trivia is brought to you by Applebee's. Choose from a variety of half-priced late-night appetizers after 9 p.m. because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only.
Good old Bloomberg with their articles just designed to make people angry. Bloomberg today asks in an op-ed article, want to enjoy your retirement? Consider delaying it. Oh, great. Can't wait to work my entire life to have to delay retirement further. This sounds fantastic. It's based on one very basic premise, which is we are living longer, which is true. On average, we are living longer, and our social programs are not designed for us to stop working in our 60s and live for potentially 3 decades after retirement. And so the question is asked, what should the appropriate retirement age be? And, if you really want to be financially secure, maybe you should potentially work longer, none of which I fundamentally disagree with. But there's this big misconception about life expectancy out there. And so I want to clarify something. So in 1960, men could expect to live to the age of 66.6 on average, women 73.1. In 2020, male life expectancy was 77.3. So, substantial increase in overall life expectancy. However, when you actually, dive in underneath the hood a little bit, most of this gain was not from people living longer. It was from improvements to like infant mortality rates and things along those lines. So in 1960, the life expectancy for men who were already 65 years old was 12.8 years. And as of 2020, it is substantially longer, but it's 17. You've increased it by 5 years. You have not increased it by 12 years. And that's a really important distinction for retirees that are looking out right now and for a whole number of different reasons. But I hear this false premise all the time. Well, we're living so much longer. And we are living longer, right? 5 years of average life expectancy at 65 is a substantially longer life. But it's not, we were dying at 75 on average and now it's 85. That is not quite the case here. So the question is, however, and this one remains, if we continue to make health developments that enable us to live longer, and those health developments continue to cost more, Medicare gets loaded up with higher prescription drugs and things like that, what are we going to do about these systems? And will Americans have enough money to live comfortably in retirement? And this is not a question that's going to get answered today, but it does look like it's a question that's going to need to be addressed within the next 8 years. And the solutions, well, nobody's tossing out any realistic solutions out there. And the frustration about that overall system, whether it's Social Security or Medicare, is the longer you wait to make changes, the more severe those changes need to be.
Right.
That's the real frustrating part, right? If you just addressed it now, then, you raise taxes a little bit, you decrease benefits a little bit, you change the retirement age, and those changes will be severe, but far less severe than they would be if we waited another 8 years and then had to address it when it was already failing. And that's most likely, in my mind, the route that we're going down, is just waiting to fix these social programs until they're failing and breaking at their base.
I'm sure. No, if you look at the annual budget in this country, how much fiscal support goes to Social Security and Medicare, and I'm not saying that they're bad endeavors, but if you're studying a budget and you're looking at cutting costs, those take up a very significant portion of our nation's budget. So scrutiny on them is really important when you're running at $1.5 trillion deficit on an annual basis and have 33 some odd trillion dollars in debt. The idea proposed in this article here that drove me the most crazy was this idea that the government should subsidize Medicare Part B premiums for those over 65 who are still employed. How is that helping our country at all from an expense standpoint to have them subsidize more in premiums for Medicare if it's only going to get more expensive?
I guess it keeps them working, contributing to Medicare for longer. I'm not entirely sure what the solution there is, but I'm going to revise this article for a moment, the subject line, to say, do you want to enjoy retirement? Well, then spend some time planning for it. It doesn't necessarily mean you need to work for longer. It might mean you need to save more now. It might mean that, if you want to enjoy retirement, you should retire now because you've got plenty saved up, and it's about prioritizing what's important to you. So I, as you can tell, dislike articles like this that just propose solutions to the masses without actually considering them. Yes, for a lot of people, you're going to need to work longer than your parents did because the social systems that are in place aren't really built to design with how long we live, and the savings programs like 401ks, oftentimes not built for the type of longevity that we are facing. But as disappointing and scary as it is to potentially retire without enough income coming in, what I find fundamentally more frustrating is working in a stressful or beyond stressful, maybe physically harmful job for longer than you need to. If you have questions about whether or not you can afford to retire, we'd love to talk to you here at the Armstrong Advisory Group. We have advisors standing by that work with our clients to help them assess not only emotionally, am I ready for retirement, but financially, will it be successful and will I be able to achieve all the goals that I want to once I find that next passion in life? You can give our office a call at 800-393-4001. Again, if you're making plans for retirement and want to know where you stand, call the Armstrong Advisory Group at 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Staying on the retirement subject, what you need to know before withdrawing funds from an inherited retirement account. Paul, let's first off just define what they mean by inherited retirement account here, because it's not necessarily, hey, my spouse, it's really not, hey, my spouse passed away and now I've got this 401k or IRA that is coming into that's coming into the fold here. What are we talking about when we talk about inherited retirement accounts?
Yeah, so typically with an inherited account from your spouse, to be clear, usually the most option that makes the most sense is just to take it over as your own retirement account. Every situation is different, but that's generally what people will look at. What we're talking about here from an inheritance perspective is if you are a son or daughter of someone inheriting a retirement account, since the Secure Act in 2019, or if you're cousin, nephew, etc., you have a 10-year window to deplete that IRA. What has happened, much to the chagrin of people who do this for a living like Mike and I, is that there was no real defined guidance as to how it should be taken out over 10 years. So initially our interpretation was, yeah, sure, we'll just work with our clients and maybe someone will take it out all in year 10. Maybe we'll take out a 10th a year, but we'll figure it out. Then there was some guidance that came out, wait a minute, the IRS wants you to be taking out a little bit each year.
And satisfying the 10-year rule.
Right. So now where we sit is each year there's been concern on our end of things for those people who have inherited IRA to make sure that they are taking out money from said account to make sure they don't run into that 50% penalty that so often retirees will hear about on their regular required minimum distributions. But for the last 4 years, Mike, we were just talking about the other day in the office, they have waived any penalties associated with it. They just don't know what to do with this.
It is so messy and just so embarrassing that the IRS cannot. 4 years in a row, they have created this rule, and 4 years in a row, they have waived the penalty for breaking the rule because they just have no idea what it's supposed to mean. This is a pretty complicated issue. I'll just mention this. So this is a really complicated issue when it comes to the waiving of these specific types of penalties. So I would really encourage everybody, if they're in this type of situation, to speak with a tax professional about whether or not it applies to you, because there are so many different rules and exceptions and what defines a qualified beneficiary and all this stuff when it comes into these inherited retirement accounts. So if you have questions, genuinely, you should speak with somebody that really knows the details on how this stuff works, because the rules changed significantly in 2019 and are continuously changing today. Let's take a quick break. When we come back, gonna have a little bit of stack roulette here on the Financial Exchange.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network.
How does your DAV membership benefit you? As a DAV member, in addition to DAV programs and services, members are entitled to a member benefits package, which gives you access to a variety of important programs, products, and services. Also included with your membership is a free subscription to DAV Magazine. For more information, visit davma.org. That's davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
If you're one of the millions of Americans at or nearing retirement age and you don't have a solid plan, it may be difficult for you to enjoy your retirement years. Hi, this is Chuck Zada from the Armstrong Advisory Group, and I've got some questions for you that may offer some guidance as to whether now is the right time for you to retire. Can you retire? Do you have enough money to live the way you'd like to? Should you retire, or have you exhausted your time in the workforce? Regardless of the answers to these and other questions, our new guide called Preparing for an Upcoming Retirement can provide some insight that may help you make the right decision. Call 800-393-4001 to request your free copy of the guide and get a head start on building your retirement plan. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family.
America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Beneficiary planning and asset protection go hand in hand, and Cushing & Dolan, the experts in elder law and taxation, can help make your planning process smooth and easy. Simply saying you're leaving everything to your kids isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can cost you dearly in the long run. That number again is 866-848-5699, or you can request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Paul, what do you have for us for Stack Roulette today?
Mike, we're going to talk a little bit about Chipotle.
Thank you for waiting at least until nearly noon to start talking about Chipotle Mexican Grill. They'll be reporting earnings tomorrow after the bell, by the way.
Ben Kitchen, one of our producers here, had innocently asked me one day, hey, why is Chipotle stock gone up so much? Just why is this such a behemoth company?
$78 billion.
$78 billion. And I paused for a moment, and I first thought he was talking about the stock split, which they're undergoing, or that may be going on later this summer. But just in terms of its size and scale in general, it's crazy, Mike, how big it's gotten from a market cap perspective. And what's crazier is that they've been able to increase their prices 6 times since 2021, and consumers are still going out there and buying their products and still selling very strongly at all of their stores. In fact, they reported 8.5% same-store sales growth in their last quarter. They are going to add 300 new locations this year. They're just really running on all cylinders. And I ran into this situation yesterday where I was up at our Woburn office, and I was ready to bite the bullet and buy from Chipotle, though I have gotten really frustrated with the price increases. So I did a side-by-side comparison, a little research here for listeners out there. Qdoba, which is also located near our Woburn office, same burrito bowls here. Steak burrito bowls, pretty standard deal. $12.79 for the burrito bowl at Qdoba. Same one at Chipotle, $15.14. 18% higher for quality that we would probably say is negligible. I guess maybe some listeners would push back.
What tasted better?
I would say that I did have the Qdoba one because also
So next time this is happening, Paul, you need to call the company and you need to, call Tucker. He'll give you the company credit card, and you got to do a side-by-side double-blind taste test. You got to have somebody up there with you to mix them up and let us know. I don't know. I have to tell you, I wouldn't even look at it. I would not even consider Qdoba as an alternative to Chipotle. I don't know what that says about the power of Chipotle's branding. But I wouldn't have looked at Qdoba. And furthermore, I was curious, so I wanted to see how expensive this stuff has gotten. I just built a beef barbacoa burrito with guacamole, so I added that and the queso blanco to really add on the cost.
Guac is $250, right?
$280.
Qdoba wasn't charging extra for guac.
$16. And I have to tell you, that is expensive.
I'd still do it.
It's not that crazy to me. I know that is...
It's a solid, healthy lunch.
It's not healthy. I'm eating...
The fresh food, yes, it is.
It's fresh food.
In that aspect, it is. It's
but
not
I'm eating
frozen,
fatty beef.
Right, but it's not a frozen hamburger that's filled with preservatives or something like that.
Now, the counterpoint that anybody listening would have is you can probably get a cheaper meal at a sit-down restaurant these days than I can get from a burrito at Chipotle. And that is a real... piece that I don't know how they handle, but quite honestly, lunch on a Tuesday, I don't want to go to sit down at a local restaurant here and go have an hour and a half long meal. I'm looking to go grab something quickly, eat it at my desk while still working, and for $16, that beats up McDonald's to me.
And order it ahead of time on your phone.
Yeah.
Here's where I'll push back a little bit. To keep it really local to us, there's this Cafe Press, which again, I know that's kind of a chain too, but I would think of it as higher quality than Chipotle. True. In terms of the products that they have. If you look at a panini from there, you're talking about $12.50 for this grilled chicken panini, where if you throw on, tax at the end, it comes close to the Chipotle burrito bowl. It might be a little bit cheaper.
That's substantially cheaper, actually, now that I think about it. Yeah, you're right.
That's where my jumping off point became, and it became specific to me because I was constantly hitting up the Chipotle that's down the street from our office when I needed to go out to lunch.
Oh, we know, Paul.
But we know. The company credit cards have the receipts. But what I saw was, I was like, you know what? If I'm just going to spend $15, I'd rather spend it at what I feel is higher quality in terms of the ingredients and food that they have comparative to Chipotle, and spend the $15 there. That's where I came down. But I'm in the minority because people are continuing to go out there.
Tell me a nationwide chain where you can get takeout with higher quality food for $16 than Chipotle.
Panera.
Yeah, Panera's right there, I guess.
I would say that.
But I would say that
but Panera's it's few and far between.
Their quality might be a step
below,
down. Yeah.
Few and far between. And a lot of this has to do with marketing, right? I think their commercials, quite honest, I don't know who voices their commercials that, they show the sizzling chicken or whatever they have
seem
on
to
there.
overdo. Yeah, I don't know.
Oh yeah, they overdo it, but they drive that message home. And Wall Street Journal's talking about the gym rats and millennials. Well, my father was coming to visit our kids the other day and made some lame excuse about how he and my mother needed to go to Chipotle to go grab his burrito before they came over here because he didn't want to eat any of the stuff in my house. So maybe he fits into the gym rat category. He's definitely not a millennial. So I don't know what is keeping this company afloat, but there is still a lot of demand for the products. And $16 for fast food does kind of sound nuts. But what am I going to pay for a full meal? No, you know what? McDonald's, I'm probably, if I'm just looking for like a single item.
$10, right?
For a meal.
I would think.
But if I'm looking for just a single item, if I want a burger or a sandwich, I'm probably at $7. That's substantially cheaper. That would be the only concern that I have is Chipotle one recession away from seeing a huge sales dent? Right? Like, if I don't have a job, I ain't going to Chipotle.
No.
I would.
Going to McDonald's. Going to Burger King. I'm going somewhere that I can actually save some money, or I'm eating beans at home, I guess.
Which was surprising. With inflation, you would have thought McDonald's would have kind of held up more, but they had seen decreased traffic. Now, they've done okay, but their growth has been a little bit more muted. Them and Starbucks have not seen the same type of growth that Chipotle has.
McDonald's, they do well in a garbage economy.
Right.
Yeah, I know that everybody's worried about recession right now, but McDonald's, some of these stores just do really well in a garbage economy. And when people are feeling like they're doing all right financially, which everybody apparently does, they all want to go travel overseas, they're not going to McDonald's. They're going and hitting up that Chipotle, and $16 be damned. They'll go shell it out. Markets remain open and in positive territory, attempting to close out a second day in a row of positive returns after a pretty rough and tumble last week. We've got the Dow up 195 points, 0.5%. S&P up about 52 points, or 1%. And we've got the NASDAQ leading the way up 221 points, 1.44%. Let's not forget about the Russell 2000. Those smaller size companies up 1.75% as we close out today's show. We'll be right back at it tomorrow. Big earnings updates from Tesla and Visa. We'll be covering those and much more tomorrow on the show.